Welcome back to another episode of Palisade Radio. I'm your host, Karem Mutlu. And on today's show, we welcome Peter Hugg, who is the Global Trading Director for Kitco Metals. Welcome to the show, Peter.
My pleasure, Karem.
Let's start by talking about a possible recession in 2020. It appears as though the Fed and the European Central Bank will try and do anything to soften a potential recession. So what's your view on this, Peter? What data do you look at to determine this possible outlook within the next year?
Well, I think it's, in my opinion, it's determined basically on the equity market. And I think the equity market is probably going to continue to have relatively flat to upside performance through 2020 because I think they have the Fed as a backstop. So I think a slowdown is coming, and GDP may not be north of 2.5%, maybe closer to maybe 1.8%. But I don't perceive that there's going to be for lack of a better way of saying this, an official recession, which is, a couple of quarters of negative growth in 2020. That may appear in 2021, but I don't think I would be one calling for a recession in 2020 from the definition of what a recession would be actually categorized as.
Well, let's talk about retail investors and the demand for gold and silver. Have you seen a major uptick in retail demand for both metals on your side? And is this a reliable indicator on where the gold and silver market may head next? I understand you hadn't seen much demand when gold was priced much lower. So does $1,500 gold signal perhaps a new psychological floor that will attract new investors from your perspective?
I think investors basically, what has happened, I think you need to break this up by market. If we're speaking on the North American investor psychology, there was a lot of physical offtake on this market between 2008, 2011, when we had that last issue, when gold hit a high of 1925. So there is a lot of physical metal already in the hands of retail investors in North America. And to get them to re-engage in this market, I think you need gold north of 1550, and if we get there, I think they'll come back in looking for the next leg higher. At these levels, I think retail demand is relatively muted. Just based on what I'm seeing coming out of both the U.S. Mint and the Royal Canadian Mint on production quotas. So, at these levels, I think retail investors are somewhat comfortable with their positions if they've got the positions already in-house. But as far as new money coming into this market, unless we see something that creates a catalyst, I think retail demand is going to stay muted until we get gold north of 1550 on a close.
Very good. Okay, let's go through some of the lessons you've learned throughout your career within the metals markets. As an investor and trader, how has your investment strategy or process changed throughout your career, Peter? And what have you learned from perhaps some of your successful investments or trades?
And I get a lot of emails on this, and they're usually very negative when I make a comment that I'm negative the gold market. Usually when I put out my comments on Kitco.com or when I speak to Danielle, I'm usually I'm speaking directly to the trader that has a short-term orientation, looking to get in at support, at support lines and selling at resistance lines. For the long-term investor, I've never subscribed to the manipulation theory that the banks are controlling the price of gold. My feeling is I've been in this market since 1974. The concept of a J.P. Morgan, selling 10,000 ounces of gold because they want to manipulate the price lower. There's no such thing in the market. I mean, you cannot sell 10,000 ounces of gold unless there's a buyer on the other side. So, if J.P. Morgan is naked the gold market, then somebody's long the gold market. So, I consider that an offset, and I think gold will always find its fundamental value, depending on, the geopolitical events at the time, interest rates. There's a variety of factors that will determine whether gold goes higher or lower. So from an investor's perspective, I've always advised my clients to look at gold the same way they would look at Apple stock. And so you look at gold as a percentage of your portfolio, and pick a percentage. Some people are more aggressive, some are less, but let's pick the old traditional benchmark that people have been talking about for the last 40 years, which is 10% of your allocation should be in hard assets, i.e. gold. It's not enough just to go and work out your portfolio at $100,000 and say $10,000 of that is going to be allocated to gold. You have to manage that portfolio the same way you manage your stock portfolio. So if you've got a 10% weighting in gold, and let's assume you did that in 2008 when gold was trading at about $700 an ounce, and and then in 2011 gold was at $1,900 an ounce. Well, if you recalibrate your portfolio as an overall portfolio every 6 months, which is what I recommend, gold in your portfolio at $1,900 an ounce would not have represented 10%. It would probably have represented 18% of your portfolio, maybe higher. At that point, you've got to liquidate that portion of your portfolio to bring you back down to 10%. Vice versa, had you bought the gold in 2011 at $1,900 as a 10% weighting in your portfolio, and then in 2016 gold hit $1,040, your weighting was probably down at 4%. You've got to buy 6%. So as an investor, if you treat gold as a percentage of your portfolio, you have to manage it. So if gold prices run higher, and now the weighting is higher than 10%, you sell to get it back down to 10. If the gold prices drop and your weighting is now lower, you buy. And in that context, you will usually get into the market at a lower price from a weighting perspective, and you'll sell when the markets take off. So it really comes down to the psychology of what the investor is looking for. Again, we're not talking about traders here. We're just talking about investors that have gold as a percentage of their portfolio. And if you treat gold the same way you would treat bonds or stocks in your portfolio, I think gold is an excellent investment over the longer term.
Excellent. And you mentioned being in the market since 1974. What was it like back in the late 70s, especially for the junior mining stocks? Can you talk a bit about that, the environment for gold and silver back then?
Well, it was extremely exciting. Nobody expected it. When I first got into the business, I got into the business as a foreign exchange trader, and then in 1978, the company that I was working for at the time, it was a bank, decided to get into the metals business, and we started very small. And we were lucky enough to get into the metals business and organize ourselves in time for the 79-80 spike in gold when gold went to $850 and silver went to $50 for the first time. So, in that context, it was an incredible time to be in the market. Bear in mind, back then, there were no computers. Everything was done manually over the telephone. So the volatility in the market, even though it was great, was nothing to what the volatility would be today with, everything being computerized and everything, sort of traded by algorithms. But we became the second largest wholesale precious metals dealer in Canada and ranked in the top 5 in North America. We were primarily a wholesale desk. And, at that point, though, inflation was running at 18%, interest rates were at 16%. So it was a totally different, a time frame on when you were looking at the metals. We had lineups at our offices that went around the block twice. We had people at the back of the line paying people at the front of the line up to $1,000 to take their ticket. Because silver was moving up $3 a day, gold was moving up $50, $60 a day. So it was an exciting environment, but not from a perspective of it made sense at the time with inflation at 18% that gold was taking off. But then after the Fed started raising rates in early 80, basically gold was in a doldrum for almost 20 years before it took off again in the early 2000s.
Okay, well, let's move on to today and talk about the junior mining stocks and which you prefer to invest in. Do you prefer large production stories, upcoming mid-tiers, or do you like to play in the grassroots exploration plays? And as gold moves up towards its all-time high, is there a strategy that you're going to use to maximize the gains within a mining bull market?
I think if you buy 10 junior mining companies, unless you get a rapid increase in gold, in which case people are just throwing money at anything. But in a normal economic environment where gold does appreciate for specific reasons, junior mining shares to me are extremely risky. If you buy 10, you can assume 9 of them are going to go to zero, and you might hit a home run with the 10th. So if I'm in the mining space, I am much more comfortable with large producers that have positive cash flow. And although the appreciation won't be as dramatic as a hit on a junior miner that might be purchased from a major, again, it's basically just you're flipping a coin on those. My preference, if I'm in the mining space, is to buy royalty companies, Franco-Nevada, Wheaton Gold, that generate revenue from a variety of mines that produce metals, and they just get a royalty stream. So if you are bullish of the precious metals market, I would be more inclined, if you're in the mining headspace, to be involved in the royalty companies as opposed to the producers.
Let's talk about some books that have helped you throughout your career, Peter. And is there anything that you've read recently that you can recommend to our listeners?
I mean, a simple answer to that would be no. I don't read books on the industry. First of all, because the data in the books is already stale dated by the time you read them. So my focus is when I get involved in precious metals investing is, I'm looking at the overall macro picture. I'm looking at where are interest rates, where is the dollar relative to the rest of the world, what are the central banks doing, and then I sort of make a decision. There's two decisions I make. Unfortunately, my primary decision I have to make is because I run the trading desk for Kitco. Is it's an immediate decision. What's going to happen between now and 24 hours from now? From a longer term perspective, as an investor, I look at the metals, and gold is one of the metals. But there are a variety of other options. I mean, copper has done very well this year. Rhodium has gone from, in the last year and a half, has gone from $2,200 to $5,000 an ounce. Palladium has gone from $1,400 to $1,800 an ounce. So there are other metals that I look at that I think have a better risk reward than gold. I'm not married to gold. I mean, gold to me is a commodity. There are times you want to be long the market. There are times you want to be short the market. I think holding a small percentage in your portfolio in gold makes sense as a hedge. But I'm not in the camp that thinks gold's going to be at $20,000 an ounce. And quite frankly, I'm hoping it never does get to $20,000 an ounce, because gold at $20,000 an ounce will pretty much mean that whatever else you're holding, including real estate, equities, are literally going to be wiped out. So, what always confuses me is when I go to conferences and I hear these guys on the stage saying hold 10% of your assets in gold, it's going to $20,000. Well, if that happens, your other 90% is going to get decimated. So, I think you've got to be careful what you wish for.
Okay, thank you very much for your time today, Peter. It's been a pleasure having you on the show today.
Karim, it's been my pleasure to be here. Thank you.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?